Thanks again for the opportunity from the team in Wholesale Investor. I'm Michael Masterson. I'll be taking you through this presentation today. I'm more than happy to share the slides via Steve and the team. So I will be going through this at a reasonable pace. So again, you're welcome to come back and look back at the slides. So what I'm going to be covering today is how you create exponential growth from these things called intrinsic assets. And I'm going to unpack this, exactly what intrinsic assets are, and more importantly, hopefully by the end of this, how you can create that exponential growth I referred to. So the first question I'd ask you quickly is just to very briefly write down what you think your business is worth, but more importantly, what do you think is really driving its value? And ultimately underpinning that value is the revenue or the margin, and ultimately how you're converting that to market share. So in terms of the team, again, you're welcome to go through this, but we now have more of the world's recognized IP strategists than any other firm in the Southern Hemisphere. Part of our team, people like Ian Fletcher, former head of the UK Intellectual Property Office, ran the spy agency. Stephen Harrison was Barrenjoey's first IPO, for those of you who were in Australia, which has grown to over $150 million market cap. So again, incredibly senior team. Some of the clients that we've helped are everyone from early stage startups, who most of you have never heard of, through to some of the world's largest companies, including people like, the SAS, who's a client I've been working with for over 10 years now. And then going through to, again, some companies I'm sure everyone knows, like Treasury Wine, who I'm sure everyone has tried their product. So again, enough about us. The 5 things that we do, though, the first is we help companies understand what their intrinsic assets are. And this will become very relevant as I take you through the case studies later in the presentation. Because until you know what you've got, then you can't deal with the risks. The reason we address risk second is because risk is the easiest way to increase value. It's typically cheaper to prevent than try and repair, which is typically very costly or sometimes not possible at all. Third area is, how do you grow the value of these assets over time and ultimately value at an exit event, which is where one of the things that we do with clients is help them to explain their value. So it's not just valuing the asset and put a numbering on it, but how do you explain it to an investor, acquirer, a joint venture partner, etc., at that capital event that enables them to hit approve on transferring those funds into your account. And then lastly is executing on that advice. And this is kind of where we get fairly close to corporate finance. In other words, taking it through to that exit event. And here we are typically partnering with other significant investment firms. So for those of you who haven't seen the Ocean Tomo data, this is showing the differential between tangible and intangible value of the S&P 500 over the last 40 years. So that's the broadest measure of economic value that we can find. Now, as you see, it's not 1975 anymore, but again, the accounting standards are essentially set for a tangible-based economy. 2 things happen in the 80s, 90s, and 2000s. The first is really obvious. We see the digital companies coming on stream, Instagram, Facebook, etc. The second thing that's happening is that American companies were offshoring their balance sheet to low-wage economies like China. But what they did is they didn't move just the what, but they also moved the how. And this is why companies like Huawei didn't wake up knowing how to become the world leader in 5G. They got taught by Nokia, Ericsson, AT&T, Bell Labs, etc. And so now, yesterday's supplier is often today's competitor. But now, if you work this out, and you work it out quite easily, you take the market cap, less the fixed assets, the debt, and the cash. The only thing left is these things that are non-physical. Now, as we're starting to see, this is becoming, aside from people like myself presenting at events like this, we're starting to see this coming up in the media more and more. In fact, Warren Buffett is very well known for talking about intrinsic value. So, but here's one of the key things that people are missing, and that is that not all of these non-physical assets are of equal value. And so that 90% actually breaks down even further. And you find that roughly 90% of the 90% are replicable intangible assets. In other words, they're not that hard to repeat with a little bit of time and typically a bit of capital. The next 9% are contributing to the ultimate value of the business. Now, again, this is by volume, not by value. But 1%, these strategic intrinsic assets, are typically where we would find 90% of the value sitting in pretty much any business. Now, the assets will change, but in terms of their volume, to their value, this is fairly representative, we find, in the sort of companies that I mentioned previously. So words matter. And we often hear these words mentioned by boards, investors, or the companies themselves. Now, I would strongly recommend please don't use these words. As you saw, I'm one of the world's recognized top IP strategists. And when a client says to me, we have lots of IP, I genuinely don't know what they're talking about. And the reason being, and the reason we talk about the intrinsic value, is because these statements are ultimately trying to explain the value of the business. And it actually breaks down into these 10 major categories. So we can pretty much break down any business, that 90%, into these 10 categories. And as you can appreciate, I can ask any company for their balance sheet, their P&L, their fixed asset register, but that's not going to typically tell me where the value is. And in our experience, companies can't produce the value, and certainly that 90%, let alone the 1%, outlining any of these 10 categories. And so, for example, in certain companies, it could be a key trade secret that could be where that 1% is. Or for companies like Coca-Cola, it could be sitting in their brand. In other words, you go and buy a bourbon and Coke. You don't typically order a bourbon and Pepsi, as an example. So we use this example, which is Instagram. And for those of you who don't know the story, there were 13 people in Instagram. And yes, I know there's 12 on the screen. We suspect that the 13th person was the one taking the photo. Now, they had no revenue and no assets when Zuckerberg comes along and initially offers $500 million for them. Now, he had a key relationship with the CEO of Instagram, who had alerted him the fact that there were other people looking to bid, notably, we understand, Twitter and Microsoft, amongst many others. This told Zuckerberg he had to overbid, or what he thought was an overbid, so he offered $1 billion. Now, at the time, everyone thought that Zuckerberg was crazy, but history's proven that not only did it stop Instagram completely demolishing Facebook, but more importantly, the asset at the time was worth between 7 and 8 billion. I think last time we had a look, it was worth around 132 billion. Now, again, where was the value in this business? And it was in those intrinsic assets. So if you think very quickly, think about your business. What are your top 3 intrinsic assets? And again, think about it from an acquirer, or more importantly, a competitor's point of view. What are the assets that they would want to steal from you? And that's probably a good first starting point. So the other thing I wanted to talk to you about is it's not just whether you've got intrinsic assets, it's how strong or weak they are. And the analogy I like to use is think about those 10 categories as fingers. Individually, they're quite weak. And quite often you will find that one of those intrinsic assets will be a thumb and one might be the tip of your pinky. Now, if you've got weak intrinsic assets, what you typically do is you are the first mover, but it's no advantage because you'll go and build the market, but you won't take the market. You're the market maker, but not the market taker. Uber is the best example we can think of here. So Uber goes out, spends hundreds of millions of dollars breaking regulatory approvals, only for people like Didi and Ola to follow them through. So where you want to be is where you go out and create the market and you capture the value of the market. And this is recognized through ultimately revenue. The revenue then converts to your margin, which is how you drive market share. But ultimately what it's doing is increasing the ROI for the investors. And I'm sure many of you are seeking how you generate better ROI. It can only come from intrinsic assets. Why? Because I can replicate the tangible assets. Where it gets harder is it gets a lot harder to replicate the intrinsic assets, and in particular, that 1% and that 9% supporting it. So let's look at value. A traditional market value is looking at really where the business has been. It's not looking at where the business is going. And so that's where the intrinsic value is starting to think about what the potentiality is of the business. And in this example, clearly from an accounting point of view, you would probably say that actually company A is better from a traditional valuation approach. But of course, we can see quite clearly, because we can look at the forward projections, that we're not averaging the last 3 years' data. We're looking at the potentiality of the revenue. But if it's got a weak intrinsic asset position, what we find happen is this. And that is that over time, it will start to nosedive. And that is because new competitors come into the market and start to compete on price. And typically that's a race to the bottom, not a good position to be in. So the word valuation is one of those words that we often hear, and it's very difficult because lots of people do valuations. But typically, to use the analogy of a stool, is they're only thinking about the seat. They're not thinking about what actually holds the seat up, e.g., what's holding up that number or that value. And, if you're a very large person, you sit on a very weak seat, that seat is going to collapse because the legs can't support it. Valuation is no different. The four key legs of evaluation is, first of all, you've got to understand those intrinsic assets, because if you don't, you can't include them in that future cash flow. And again, everything comes down to the potential cash flow of that business. Second of all is the context. In other words, like Instagram, who is the potential buyer, acquirer, joint venture partner? If Google's buying the business as opposed to, the small store owner around the corner, then obviously that business is worth a lot more. Three, as we found very recently, timing. We had a client that we helped go through an exit event in January 2020. That business went for a very large amount of money. 6 weeks later, because they were involved in airports, that business was probably worth zero. That business today, though, is probably worth 2, maybe even 3 times that value of January 2020. Now, even if you get all of that right, the fourth leg is the most important, because at this point, no one has hit approve on that transaction. And the only way they're going to do that is if the value makes sense to them. In other words, and more importantly, that they can explain it either to their credit committee, maybe their wife if they're a high net worth, or potentially their ultimate funder being a bank. So again, it's really about value explanation. Again, I'm sure I'm preaching to the converted. So an example of this is a client that we worked with recently. Some of you may have heard of a company called Agros. So Agros have come up with a way to produce plasma from blood at 50% of the cost. For those of you familiar with CSL, this is a significant revenue line for CSL, one of the largest companies on the ASX. When we first met them, they were about to IPO. They were definitely not ready for IPO. They were a very small business, in fact, only a few people, and they needed some short-term cash. First thing we did is we helped them understand their assets. They had a cost advantage, and what that told us is they had to have strong intrinsic assets. We stopped them filing a patent and kept, in fact, a number of things that were going to be included in that patent as a trade secret. That enabled us to then do the first valuation of circa $32 million. In fact, we went on to value them. And if you want to go and have a look at an article done in October last year in the AFR, it's a great article that explains where the value was in their business, which was circa $300+ million. The reason that they were worth that is because the underlying intrinsic assets and the market potential supported that. They were oversubscribed. We've recently valued them at over $1 billion. Again, they were oversubscribed. Now, this is pre-revenue. And again, you can't end up with people oversubscribing if they don't understand the value. But Agros is certainly on track to certainly disrupt this market. The next one, AirTrunk. Some of you, I'm sure, will know AirTrunk. Incredible story, started by Robin Cooder. So Robin called me about 5-6 years ago. Said, look, I've come up with a way to run a computer data center at half the operating cost of everyone else. I'm like, that's amazing. How are you going to protect it? So I immediately knew that he had to have great intrinsic assets. He said, well, I'm looking at filing a patent. I said, Robin, you could file a patent, but you shouldn't file a patent. Because the moment you put in your patent, what's giving you that cost advantage, your competitors are going to then take that, and no judge is going to give you access to a data center. They're incredibly secure facilities. He said, so I should go get a job. I said, no, we can value this. So again, we got his strategy right. We worked out what the risks were, and then we were able to explain it. And then through the great work at Grant Samuels, they had a very successful initial raise at a valuation of $200 million. They subsequently sold 78% to Macquarie for $3 billion. As you've seen recently in the press, they're now looking for a $10 billion IPO. Again, if Robin hadn't have worked out what his assets were, dealt with the risks, got the strategy right, then it wouldn't have enabled that value explanation and certainly wouldn't have enabled those capital events to follow. So risk, unfortunately, the dark side of what we deal with, and that is that the more valuable your assets become, obviously, the more likely it is that someone's going to want those assets or replicate that market or go after your market share. So they're different to tangibles. Tangibles are very easy to replicate. And, like different assets, in fact, even different intrinsic assets, you've got to protect them differently. And This can come from a number of factors. So typically when staff leave, often those intrinsic assets go because the originating company has never captured them properly. This happens again with market expansion because you're putting new staff into new markets, or more importantly, you're hiring new people that you might not know. As I mentioned with AirTrunk, patenting it what should be kept as a trade secret, or the opposite, keeping something as a trade secret that maybe you should be patenting. We often see that companies don't have much capital to be able to afford good advice when they first start, and this often sees no agreements or very bad agreements being formed. Again, as companies scale, they're often not distributing this information down to staff, and often when they're doing joint ventures, often it's confused as to who actually owns the assets, in particular with places like universities. So this is a great example. So Rhino-Rack, who we started working with just over 5 years ago. So Rhino-Rack, dominant in their space. We worked with them to initially identify that they hadn't captured one of their major assets, which was some customer data. That customer data ended up being very, very valuable. Now, initially, they thought they were worth circa $100 million. Fast forward, they start to build up those assets, and along comes a company called Claris out of the US who owns brands like Black Diamond. They offered them $255 million, and ultimately that was what went into their bank account. Now, as you can appreciate, it's not that the value of the plant, the equipment, the machinery went up 155 million. It was ultimately the intrinsic assets that were supporting that number, and that's ultimately what Claris bought, because they could replicate the tangibles, but they couldn't replicate the brand, the systems, and in particular that customer data. So second thing I'd get you to do is just think about, what do you think your top 3 risks are? And again, think about it. If you were a competitor, where would you start to diminish your own business? Would it be hiring out key people from your organization and hoping those intrinsic assets come across to you? So the last thing that I'd like to finish on is exponential growth. And that's why we're here. But you can't get to exponential growth unless you know what you've got. You've dealt with the risks. And in this situation, tangibles can't scale more than 24/7. You can only operate them. They're physically restricted. Whereas intrinsic assets are the only way you can operate beyond those physical barriers. And if we think about something like a mining business, the tangible is obviously the land, but the key intrinsic asset is the ability to mine that land. In other words, it's not just the hole, it's the ability to even start digging the hole. Then it's what you bring out of the hole and what you do with those assets that also come out. So there are 3 ways to make money from an intrinsic asset. The first is what most companies do. They deploy. They create the product or the service. They go and sell it. And then ultimately, they hope that someone comes along with a large check and acquires it. Second is licensing. So what you're doing here is you're transferring risk from you as the inventor through to someone else who goes out and does what you would do in deployment. And they pay you a fee for that. Or 3, hopefully, they give you a really large check, in which case they go and either deploy or they license. Now, the reason that people go for deployment typically is because that's ultimately, over time, the way you generate the most amount of revenue. But of course, you need a lot of capital to expand. Typically, you need time. And as I mentioned, there is a risk factor here. And by moving backwards, you're diminishing the time, the capital, and the risk that you're putting at exposure. So I'm sure we've all seen the 3 Cs. This is nothing new. But again, it's like a 3-legged stool, and we often see early stage companies or companies that are scaling that are out of kilter. In other words, they typically lack capital, I'm sure, while you're sitting on this presentation. But that capital has got to be supported by the ability to deploy that capital and create further value for investors. But where it ties in, as I mentioned previously, is that even if you've got this great market need and you've got your 3 Cs right, you've got to have a strong intrinsic asset position to create sustainable return on investment over time. And this is the trick, as we all know as investors. It's not just getting the initial sugar hit like the first investors in Uber did, but how do you continue to get a return on investment from that asset? So here, think about, what do you think your 3 things that you could do to create exponential growth? Is there a product or a service that you could create in certain markets? Now here, they're also not mutually exclusive. E.g., you may deploy in your home market, you may license into another, and you may even sell the entirety of your rights in a market you're not planning on going into. So these are my kind of cheat sheets. So these are the questions that I typically think about when I'm trying to scale a company. And it really starts with the very obvious one that I said at the start. Just start with what intrinsic assets you own. Think about, are you actually maximizing and sweating the asset as much as possible? Is there a strategy around that? Is that strategy now tied in with the broader business strategy? What's your capital strategy, marketing, sales, etc.? 5 is, are you actually running fast enough? And ironically, here we're seeing risk in a positive. In other words, are you taking enough risk? Are you scaling? And we typically see this in biotech and medtech. 6, I've certainly learnt this lesson the hard way. You know, asking, for example, not to pick on patent attorneys, but can I get a patent? Is like asking my barber, do I need a haircut? And the answer is yes, you do. So again, you really want to be getting that advice from someone who doesn't benefit from that outcome. 7, have they spent time on the battlefield? You know, it's very hard to talk about what's the best way to protect those assets unless you've actually experienced it directly. 8, coming back to valuation, is again that first leg of the stool. Are you incorporating those intrinsic assets into your valuation? Because if you're not, you're certainly leaving value on the business. And last but not least, but if you're putting that valuation together and you don't understand how the 4 legs work, that seat is going to be wrong. And typically it will be undersized. Or as we've seen with certain IPOs, they've certainly been oversized. So to finish on a note, we're all aware that early stage companies have a very high failure rate. In fact, in this example, over 10 years, it's 65.5%. I found numbers as high as 90%. Now, the reason for failure can be addressed. And the good news is that by coming up with what that growth plan is, you can address 3 of the top 4. Now, by explaining the value, you're much more likely to deal with the bottom 2, which is running out of cash. Why? Because people know what they're investing in. They know how they're going to make their money back. So one of the ways that we do this is through what we call snapshot. And this is something that a number of investors and also operating companies, and the analogy I use here, it's a bit like a building report for a house. In other words, you need to look at where the current position of the company is and what the potentiality is. And if we use AirTrunk here, AirTrunk, we probably would have given an F- if they had have gone and patented what were key trade secrets. But by keeping them as trade secrets, they actually went to an A+. In other words, they're very investable. And so this really starts with a process of education. And again, as I mentioned, it's about getting people to ask the right questions so that they can therefore try and find the right answers. But ultimately, you know, point 4, it's about making this actually happen. In other words, there is no point having a strategy unless you're prepared to turn it into an action. So I will finish on this question. And hopefully, if I've done my job right, your answer to question 1 has now changed. And really what I'm trying to do here is get you to think differently about your business or about the investments that you're making. Are you asking the right questions to hopefully end up with the right answers? So I'm Michael Masterson. Thank you so much for your time. And thank you again to the Wholesale team to share this hopefully insightful presentation with you. One of the things that we offer any company is we're happy to jump on a call for an hour. We don't charge for that. And again, hopefully we can get you asking some new questions that you might not be thinking about. Once again, thank you for the opportunity and thank you again to the team at Wholesale Investor.